Welcome aboard Rocket Ship, the platform with the most relevant content for competitive examinations. This is Rocket Ship IAS Lab and continuing with our series on answer writing for general studies papers of civil services main examination, we take up a question that you might come across in GS paper 3. Please read out the question carefully. Institutional autonomy is a necessary precondition for regulatory bodies to function effectively. Discuss with a special reference to central banks. Giving examples from India. Basically, you would probably understand that this question talks about the, you could say, institutional autonomy that is granted to India's central bank, that is the Reserve Bank of India. And as you can see, the first part of question itself makes this point. It points to the theme of institutional autonomy, that is a required condition, that is a prerequisite for, you could say, effective working of regulatory bodies like RBI, or for that matter SEBI, etc. But in the second part of the question, you have to actually establish this, you could say, entire argument through giving examples, through backing examples from India's case, basically in the case of Reserve Bank of India. We are introducing our answer with making a very, you could say, well-known point that India has pursued the modern market economy. In the modern market economy, regulatory bodies are entrusted with vital functions. They ensure that unchecked greed and perverse incentives do not lead to market failure. Actually, this is a very, important concept in modern economics, basically behavioral economics, the concept of perverse incentives. We would suggest that you look it up. However, what it means, perverse incentives essentially means a situation where someone is actually prompted to take more risk than actually the system can manage, because he does not have much to lose by taking risk. But if the risk pays off, he would probably gain a lot. To give you just one example, for an example, a bank official might be prompted to, you could say, lend indiscriminately, because his incentives, for an example his commissions, or for that matter his promotion, etc., may be actually based on his performance on, you could say, giving more loans. But if the loans are not repaid, the same official would not suffer any loss. He would not probably, he won't be even accountable for the loss that has been caused. So this is a classic case of perverse incentives, where a person is actually incentivized to take risk because he is not going to suffer anything if the entire risk backfires, basically. Regulatory bodies include institutions tasked with supervising equity and bond market, monetary policy, and banks, etc. As we have given the examples of SEBI, RBI, etc. SEBI is actually tasked with supervising the equity, bond market, etc. And in India's case, the monetary policy and the banks, etc. are supervised by the Reserve Bank of India. In India, SEBI and RBI are two examples of regulatory bodies. Central banks like RBI have, this is a very, important observation on there, you could say, very rationale why they exist. The central banks exist. They perform a tightrope walking. Basically, they have to balance two seemingly contradictory objectives, as we would see in the discussion. The central banks have to perform a tightrope walking. On the one hand, they have to ensure that the consumption demand is robust so that the engines of the economy are running. On the other, they have to keep the inflation rate in check. Basically, you can understand very, well that some of the ways through which we can actually boost consumption, for an example making it cheaper to, you could say, borrow, can actually fuel inflation. We would repeat it, some of the you could say measures to boost consumption, for an example cheaper loan rates, can actually fuel inflation. The central bank has to ensure that lenders do not ignore, and moreover, the lenders do not ignore that the repayment capacity of potential borrowers just to expand their loan book, as we have given in the example through the bank official who has the perverse incentive of lending indiscriminately. but the central bank, that is the RBI, has to ensure that the borrower has the repayment capacity, so that ultimately whatever he has borrowed has to be, you could say, back with the bank, so that the bank can actually pay its, you could say, savers, the people who are actually making savings account with the bank has to ultimately pay them, or for that matter any other depositor. These contradictions in the goals of central banks have policy dimensions as well. Basically, we are pointing to the political dimensions, to the objectives of the central bank, that is a Reserve Bank of India. Sometimes policy makers may be pursuing short-term goals, basically, while the central bank is more focused on long-term systemic stability. Once again, to repeat the same example, for an example, policy makers might prefer inflationary policies like low interests, and rightly argue that low interests may fuel consumption and also investment in, to give you just one example, investment in real estate to build long term wealth. You would have probably observed that people actually are prompted to, you could say, borrow more for home loans, etc., when the rates are, when the, you could say, the interest rates are low. So this can actually help them build long term wealth. However, the central bank's point of view has made it that indiscriminately lending may create systemic risks, including bad loans that burden bank's balance sheet. What would actually happen? The bank has actually got some deposit from the depositor, but if the borrower does not repay him, what it would essentially mean that the bank won't be able to repay the depositor. Basically, that would create a, you could say, vicious cycle for the entire economy. The market would actually lose faith in the system, as you would have heard of terms like run on the bank, etc. This is a panic situation, run on bank, panic situation where people start withdrawing their, you could say, deposits very very fast, basically. So all of these things can actually happen if there is indiscriminate lending. That is why the RBI comes into play, and it actually ensures that the borrower has the repaying capacity to justify, you could say, taking more debt. It is in similar instances where regulators and policy makers differ that the regulator must be protected from outside pressure and interference. Basically, sometimes they may have conflicting objectives, but if the political, you could say, executive was allowed to interfere in the working of the RBI won't be able to decide with the, you could say, with the long term in the mind. And that, as you can see, that would essentially mean that long term there would be much more problem than the solutions that we provide in the short term. It is for ring fencing, basically insulating the central bank, that a principled autonomy has to be affirmed. Now, coming to India's specific case, successive governments in India deserve all credit to respect RBI's autonomy. This has served India remarkably well, that the autonomy that has been affirmed to Reserve Bank has served India remarkably well, even during crises like the Great Recession of 2008 and the coronavirus pandemic of 2020-23. Actually, in both of these, you could say, major crises, India came out mostly unscathed. Mostly, India too suffered some losses, but India came far better than most of its peers, actually. And this was one of the, you could say, one of the credit that goes to is the, you could say, autonomy that the RBI enjoyed. Basically, RBI's autonomy was respected by the entire political class. It did not interfere in the working of RBI, so RBI could actually take steps without, you could say, fear of, you could say, policy interventions and so many other things. There is legal framework like RBI Act, balancing autonomy and the need for intervention in the working of RBI. Actually, the RBI Act provides that the government would interact with the RBI's board through the governor. Basically, the RBI's working is mostly insulated from direct intervention of the government. That is, the government actually can interfere in the working of RBI, but that has to be through a proper channel, through the governor. Moreover, with the coming into, you could say, existence of the Monetary Policy Committee and Inflation Targeting Framework, which provide policy clarity to RBI, setting a desired band of inflation rate. You are almost certainly aware that this band is not more than not less than 2%, but not more than 6 exactly. Oh, sorry. Anyway, it is, yeah, the more desirable rate is 4%, but it should not be more than 6% and less than 2%. So basically, when you establish a standard that the RBI has to follow, it means that you would have much less cause of interfering in the working of RBI. That is why we can say that with inflation targeting and MPC coming into force, RBI's autonomy has actually been strengthened. This boosts RBI's autonomy. In final analysis, RBI's very sanctity as a regulator requires autonomy. As we have established that its very sanctity as an effective regulator requires autonomy. However, we can, this is a very, very important observation. We would suggest you highlight it. We can paraphrase Sri Y.V. Reddy, former governor of Reserve Bank of India, to emphasize on the need for transparency in RBI's decision making. Mr. Y.V. Reddy said that on the one hand, he actually made this observation that RBI should grab its autonomy. Basically, RBI has to actually make this point to the policy makers that it needs autonomy. He had such a strong, you could say, feeling about RBI's autonomy. But at the same time, he also said that RBI should actually balance it through proper communication. That is, the RBI should communicate the rationale behind its action. That is, whenever RBI takes, you could say, particular steps, particular decision, etc., it should always communicate it to all the stakeholders, including the policy makers and even the wider audience. That is the suggestion Mr. Y.V. Reddy was making. We would suggest you include Mr. Y.V. Reddy's observation, and in fact you look it up, what Mr. RBI Reddy had Mr. Y.V. Reddy had observed. Anyway, this was all on institutional autonomy and how it strengthens the regulator, especially in the with the India's case of the central bank, basically the Reserve Bank of India. This is all for today. We would reassemble for the next lecture in a few days. As usual, we wish you all the best. Thank you.